Most high net worth individuals operating globally have made the same architectural decision. They have consolidated one trust structure, one primary banking relationship, one dominant jurisdiction for tax reporting and fiscal residency anchoring. The logic appears sound on the surface: lower administrative overhead, simpler fiduciary management, a cleaner balance sheet with unified reporting lines. But this is the retail mindset applied incorrectly to institutional scale capital. In a volatile sovereign environment, consolidation does not reduce risk. It concentrates it into a single target. What you have built is not an efficient structure. You have built a single point of failure. The moment a sovereign reclassifies your capital, mandates beneficial ownership disclosure, or introduces a cross-border unrealized capital gains event, a consolidated structure gives that sovereign complete access to your entire balance sheet in a single legislative move. There is no isolation. There is no partition. There is no legal buffer between the triggering event and the asset itself. The administrative savings you achieve by consolidating are irrelevant. Once that event fires, you are not building for performance in calm markets. You are building for isolation under sovereign pressure. And consolidation, by definition, removes the isolation. This is not a theoretical risk that might materialize in a decade. It is the defining financial hazard of this period. And it is compounding as the G20 beneficial ownership transparency push accelerates beyond what most private advisors anticipated, even 2 years ago. The advisors who built those consolidated structures were optimizing for the wrong variable. They were reducing administrative costs while concentrating sovereign risk. That trade-off is no longer acceptable. The mechanism by which consolidated structures collapse is not dramatic. It is sequential and almost bureaucratic, which is precisely what makes it so dangerous. We call it the cascading failure model. It begins when a sovereign in one jurisdiction, say a G7 nation fully participating in the common reporting standard, triggers a forced liquidity event through an exit tax applied to an asset deemed locally situated. That event creates a taxable disposition. The disposition requires immediate liquidity, but if your liquid capital is also housed under the same trust deed, governed by the same fiduciary jurisdiction, the liquidation pressure does not stay contained. It transmits across the balance sheet. Assets in a second country must now be unwound to cover the liability created in the first. What appeared to be a geographically distributed portfolio was at the structural level a single entity. The unrealized capital gains exposure in one asset class forces a crystallization event in another. The advisor who designed the consolidated structure will tell you this is a tax problem. It is not. It is an architecture problem. The cascade is not a consequence of the tax policy. It is the direct consequence of how the balance sheet was built. And it plays out in a matter of weeks, not years, once a forced disclosure or repatriation event is formally initiated. The structure is the vulnerability. And no tax advisor, no matter how experienced or well-connected, can unwind a cascade once it has started. The only solution is prevention through architecture. The institutional world has already solved this problem and rebuilt its architecture accordingly. Multinational corporate treasury operations in the late 20th century made the same consolidation error at scale. Firms ran centralized treasury hubs, single currency, single entity structures because they were simpler to administer. The 2008 liquidity crisis exposed this as catastrophic. Firms with partitioned, legally isolated treasury subsidiaries across multiple jurisdictions absorbed sovereign pressure and contained compartments. A failure in one entity did not transmit to the others. Firms with consolidated treasury structures collapsed from a single counterparty failure because there was no legal barrier between the triggering event and the full balance sheet. The institutional world rebuilt on the principle of compartmentalization. The lesson from 2008 was not diversify your assets. It was partition your governance. That distinction, operational diversification versus legal compartmentalization, is the architectural gap that most private wealth structures still have not closed. The reason is partly incentive. Advisors who build simple, consolidated structures generate lower fees but face no liability when those structures fail under sovereign pressure. The risk of that failure accrues entirely to the client. Under the current expansion of common reporting standard frameworks, fiscal residency reclassification, and the creeping application of unrealized capital gains taxes across G7 jurisdictions, that gap now carries a measurable and compounding structural risk that consolidation cannot absorb. This is the structural transition that separates institutional capital from retail capital. The retail approach consolidates for simplicity. The institutional approach partitions for survivability. One engineering discipline defines the difference: compartmentalization. The solution is what we call the multi-tier sovereign trust architecture. It is not additional complexity for its own sake. It is the engineering discipline of sovereign isolation applied to a private balance sheet. The framework operates across three distinct tiers, each governed by a separate legal regime, each insulated from the fiduciary and regulatory jurisdiction of the others. Tier 1 holds your liquid capital in a jurisdiction with no capital controls and no participation in beneficial ownership disclosure registers. Tier 2 holds your core operational assets, private equity interests, real estate vehicles, and business holdings in a jurisdiction with an independent, treaty-protected fiduciary seat, entirely decoupled from your personal fiscal residency anchor. Tier 3 manages that fiscal residency anchor itself, selected not as a tax optimization strategy, but as a sovereign buffer, a jurisdiction with stable treaty networks, limited unrealized capital gains exposure on foreign-held assets, and no participation in automatic information exchange for private trust structures. The fiduciary governing each tier answers to a different legal system. There is no single deed, no single trustee, and no single legislative event that can simultaneously claim all three tiers. The assets are not merely held in different countries. They are governed by different legal orders that do not recognize each other's authority to compel disclosure or force liquidation. That is the structural objective, not asset diversification. Legal partition. The critical design principle is that no single sovereign action can reach all three tiers simultaneously. A wealth tax introduced in your Tier 3 fiscal residency jurisdiction does not automatically trigger a taxable event in your Tier 1 liquid capital vehicle, because the governing law and the beneficial ownership disclosure framework are legally distinct. A forced repatriation order directed at Tier 2 operational assets does not cascade into Tier 1 because they are not commingled under a single trust deed. A common reporting standard information request submitted to your Tier 3 residency's jurisdiction does not grant access to the fiduciary records of your Tier 2 structure because the treaty architecture governing that seat explicitly insulates it from third-party sovereign requests. This is why the selection of fiduciary jurisdictions is not an administrative decision. It is a structural one. The treaty map matters as much as the asset allocation. If you are building this structure and your advisor is treating jurisdiction selection as a tax efficiency question rather than a sovereign partition question, you have the wrong advisor. This is the institutional architecture that the G20 transparency agenda was specifically designed to challenge and erode. Your response to that challenge is partition, not exposure; compartmentalization, not consolidation; sovereign pressure is not the fundamental risk; structural permeability is the risk. The pressure only reaches the assets if the architecture allows it to. The legal infrastructure underpinning this architecture draws from well-established fiduciary traditions with decades of settled case law. Tier 1 jurisdictions typically include the Cayman Islands, BVI, or the Cook Islands, structures that predate and remain treaty-exempt from the most aggressive common reporting standard expansions. The reason these jurisdictions retain viability is not opacity. It is the treaty grandfathering provisions embedded before the CRS framework was finalized, which remain legally enforceable. Tier 2 fiduciary seats draw from Liechtenstein, the UAE, or Singapore, where treaty-protected foundations and private trust companies operate under legal frameworks that explicitly resist beneficial ownership disclosure to third-party sovereign requests. Tier 3 fiscal residency anchors are selected from a narrowing but viable pool: Paraguay, Panama, Georgia, or the UAE, jurisdictions where residency is real and functional. and where unrealized capital gains taxation on foreign-held assets does not attach to individuals who have properly decoupled their personal residency from their asset governance layers. The pool is narrowing because G20 pressure on compliant jurisdictions is increasing and treaty frameworks are being renegotiated under duress. That is precisely why the structure must be built before further treaty erosion occurs and before the compliant jurisdiction count drops below the threshold needed for effective three-tier compartmentalization. This architecture is not offshore secrecy, it is lawful sovereign compartmentalization. The distinction matters because the structure must be defensible, not merely deniable. The performance benchmark for this structure is not yield, it is survivability. When stress testing this architecture, the relevant question is, if a hostile legislative event occurs in any one of these jurisdictions, a new exit tax, a beneficial ownership mandate, a forced transparency protocol, how much of my total balance sheet is exposed? In a consolidated structure, the answer is a 100%. In a multi-tier sovereign trust architecture, the answer is the assets governed by that single tier, ring-fenced and isolated from the others. The unrealized capital gains exposure that emerges in one compartment does not detonate the capital held in another. The common reporting standard event that reaches your Tier 3 fiscal residency anchor does not automatically reach your Tier 1 fiduciary vehicle. This is not a marginal efficiency gain over traditional wealth structuring. It is the structural difference between a balance sheet that absorbs sovereign pressure in one insulated compartment and a balance sheet that is fully liquidated because no architecture existed to stop the cascade. The consolidation model optimizes for administrative simplicity in a world that no longer exists. That world is over. The expansion of common reporting standard reporting obligations to over 120 participating jurisdictions, the introduction of unrealized capital gains taxes in 3 G7 nations in the last 18 months, the coordinated G20 push for beneficial ownership transparency. These are not isolated policy events. They are structural signals. The sovereign landscape has permanently shifted against consolidated single-tier private wealth structures. The only rational architectural response is partition, multi-tier, compartmentalized, governed by distinct legal regimes, built not for performance in calm markets, but for isolation under sustained sovereign pressure. That is the sovereign shelter.
Join our community of informed investors to stay ahead. This data is for education and is not financial advice. Always consult a professional before investing. To speak with one of our specialists, click the link in the description. I'll see you in the next report.